Alrighty, fellow ape holders, XMAX Trading here. Go ahead and hit subscribe to the channel and click the like button. Just going over a video today on the anatomy of a short attack, written by Seeking Alpha, and pretty interesting how short attacks happen in the stock market. Obviously relevant to AMC, and this is not financial advice. So getting to the article, Anatomy of a Short Attack. Abusive shorting are not random acts of a renegade hedge fund, but rather coordinated business plan that is carried out by a collusive consortium of hedge funds and prime brokers with the help from their friends at DTC and major clearinghouses. Oh damn, that's a lot. Potential target companies are identified, analyzed, and prioritized. The attack is planned to the most minute detail. This is like a bear raid on steroids. The plan consists of taking a large short position, then crushing the stock price, and if possible, putting the company into bankruptcy. Wow, this makes Game of Thrones look tame. Bankrupting the company is a short home run because they never have to buy real shares to cover, and they don't pay taxes on the ill-gotten gain. When it is time to drive the stock price down, a blitzkrieg is unleashed against the company by a cabal of short hedge funds and prime brokers. The playbook is very similar to an attack, and the participating prime brokers and lead shorts are fairly consistent as well. Typical tactics include flooding the offer side of the board. Ultimately, the price of a stock is found at the balance point between supply and demand, the offer and bid. For the shares to find equilibrium. This equation happens every day for every stock traded, probably every second every day. On days when more people want to buy than sell, the price goes up. And conversely, when shares offered for sale exceed the demand, the price goes down. The number of shares offered for sale. Shorts manipulate the laws of supply and demand by flooding the offer side with counterfeit shares. They will do what has been called a short down ladder. It works as follows. Short A will sell a counterfeit share at $10. Short B will purchase that counterfeit share, covering a previously open position. Short B will then offer a counterfeit share at $9. Short A will hit that offer, and short B will come down and hit short A's $9 bid. Short A buys a share for $9, covering his open $10 short, booking a $1 profit. So kind of back and forth between each other. By repeating this process, the shorts can put the stock price in a downward spiral. If there happens to be a significant long buying, then the shorts draw from the reserve of strategic fails to deliver, and flood the market with an avalanche of counterfeit shares that overwhelm the buy-side demand. Attack days routinely see 80% or more shares offered for sale as counterfeit. Company news days are frequently attack days, since the news will mask the extraordinary high volume. It doesn't matter whether it's good news or bad news. Sometimes the shorts will publish their own FUD stories trying to make the price go down. And of course, Motley Fool is pumping out FUD articles every fudding day. Flooding the market with shares requires foot soldiers to swamp the market with counterfeit shares. An offshore hedge fund, like in the Cayman Islands with Citadel, an offshore hedge fund devised a remarkably incentive program to motivate the traders at certain broker dealers. Each trader was given a debit card to a bank account that only he could access. The trader's performance was tallied, and based upon the number of shares moved, the other success parameters, the hedge fund would wire money into the bank account daily. At the end of each day, the traders went to an ATM and drew out their bribe. Instant gratification. So the number of shares they moved, and then other success parameters, the hedge fund wire money. Yeah. Global Links Corporation is an example of wholesale counterfeiting of shares would decimate a stock's price. Global Links is a company that provides computer services to the real estate industry. By early 2005, their stock price had dropped to a fraction of a cent, and at that point, investor Robert Simpson purchased 100% of Global Links' 1.158 million issued in outstanding shares. He immediately took delivery of the shares and filed the appropriate claims with the SEC. Disclosed that he owned all the company's stock. His total investment was $5,000. The share price was at .004. The day after he acquired the company's shares, the volume of the over-the-counter shares was 37 million. The following day, 22 million shares changed hands, all without Simpson trading a single share. It is possible the SEC had been conducting a secret. It is possible the SEC had been conducting a secret investigation, but that would be difficult without the company's involvement. It's more likely the SEC has not done anything about this fraud. Massive counterfeiting can drive the stock price down in a matter of hours on extremely high volume. This is called crashing the stock, and a successful crash is a one-day drop of 20% or 35%. A one-day drop of 20% or 35% drop in a week. In order to make the crash stick and make it more effective, it is done concurrently with most of the following: a media assault. The shorts, in order to realize their profit, must ultimately put the victim into bankruptcy and obtain the shares at a price much cheaper than what they were shorted at. These shares come from the investing public who panics and sells into the manipulation. Panic is induced with the assistance of financial media. The shorts have friendly reporters from the Dow Jones News Agency, Wall Street Journal, Barron's, New York Times, Gannett Publications, CNBC, and others. The common thread is the friendly reporters worked for TheStreet.com, an internet advisory service that short hedge fund managers David Rocker and Jim Cramer own. This alumni association supported the short attack by producing slanted, libelous, innuendo-laden stories that disparaged the company as it was being crashed. One of the most outrageous stories was a front-page story in USA Today during the short crash of Taser stock price in June 2005. The story is almost a full page, and the reporter concluded that Taser's electrical jolt was the same as an electric chair. Proof positive that Tasers did indeed kill innocent people. To reach that conclusion, the reporter overestimated Taser's amperage by a factor of 1 million times. This quote-unquote mistake was made despite a detailed technical briefing by Taser to 7 USA Today editors 2 weeks prior to the story. The explanation, due to a mathematical error, appeared 3 days later, but the damage was done to the stock price. Jim Cramer, in a videotaped interview with Street.com, best described the media function. When shorting, the hedge fund mode is not to do anything remotely truthful, because the truth is against your view, so you as the hedge funds create the truth, that is the development of the fiction. You hit the brokerage houses with a series of orders, short down ladder, and push the prices down. Then we go to the press. You have a vicious cycle down. It's a pretty good game. This interview, which is more like a confession, was never supposed to get on the air. However, it somehow ended up on YouTube. Cramer and the Street have made repeat efforts with some success to get taken off of YouTube. Analysts report some alleged independent analysts are actually paid by the shorts to write slanted negative ratings reports. These reports, which represented as being independent, were ghostwritten by the shorts, disseminated to coincide with the short attack. There is congressional testimony on the matter of Gradient Analytic and Rocker Partners that expands upon this. These libelous reports will then become a story in the aforementioned friendly media, all designed to panic small investors into selling their stock into manipulation. Also, there's a planting of moles in target companies. Shorts plant moles inside target companies. The moles can be as high as the directors or as low as janitors. They steal confidential information, which is fed to the shorts, who may feed it to friendly media. The information may not be true, may be out of context, or stolen documents may be altered. Things that are supposed to be confidential, like SEC preliminary inquiries, end up as front-page news with the short friendly media. Surprise, surprise. There are also frivolous SEC investigators. Shorts leak tips to the SEC about corporate malfeasance by the target company. SEC can take months processing Freedom of Information request and swoops in as a supposed confidential inquiry is leaked to the short media. Plethora of corporate rules means SEC may ultimately find minor transgressions, or there may be actually no findings. Occasionally, they do uncover an Enron, but the initial leak was counted on to drive the stock price down by 25%. The announcement of no or little findings months later can come out, but by then the damage has been done. Stock price destruction is irreversible. San Francisco office of the SEC appears to be particularly close to the short community. There's also class action lawsuits that help the shorts, allegations of accounting improprieties. They could be interfering with the target company's customers' financing. If shorts become aware of clients, customers, or financing of the target company was working on, they could be called to tell lies and otherwise attempt to persuade the customer to abandon the transaction. Allegedly, the shorts have gone so far as to bribe public officials to sway them from using a company's product. Pulling margin from long customers. Clearinghouses and broker-dealers who finance margin accounts will suddenly pull all long margin availability, citing very transparent reasons for the abrupt change in lending policy. This causes a flood of margin selling, which further drives the stock price down, gets the shorts the cheap long shares they need to cover. Pulling margin. Wow. Paid bashers. The shorts will hire paid bashers who invade message boards. Yeah, like Reddit, Wall Street Bets, whatever, stock twits. Invade the message boards of the company. Bashers disguise themselves as legitimate investors and try to persuade or panic sell small investors into the manipulation. Confessions of a paid stock basher. Wow. This is not every trick the shorts use when crashing the stock. Almost every victim company experiences most of these tactics or all these tactics. How persuasive is this? In any given moment, there's 100 emerging companies under attack as described above. This is not to be confused with day-to-day shorting that occurs virtually on every stock, which is purportedly about 30% of the daily volume. Success rate of short attacks is over 90% a success. 90%. A success being defined as putting the company to bankruptcy or driving the stock price into pennies. It is estimated that 1,000 small companies have been put out of business by the shorts. Admittedly, not every company deserves to succeed, but they do deserve a level playing field. I agree with that. The secrecy that surrounds the shorts, prime brokers, the DTC, the regulatory agencies makes it impossible to accurately estimate how much money has been stolen from the investing public by these predators. But the total measure is in the billions of dollars. The problem is international in scope. To learn more, go to counterfeitingstock.com. Wow, I gotta have a drink after this. Leave a comment in the section below, guys, what you think about these short attacks. Alright, thanks, and until next time.